What trends are you riding? The question we ask every week on Thursday. Got to be honest, if every week was like this week, I'd probably take some time off. Okay. If you've been looking at US markets, they've been on the move. If you've looked outside the US markets, they've been on the move. If you're talking about stocks, if you're talking about derivatives, if you're talking about maybe different products, man, everything's been moving. My gosh, it's been exhausting, but in a good way. Let's go ahead and talk about some of these trends. We've got Scott Thompson with us. He knows something about trends, and we welcome Scott. We welcome all of you here today. Now, just real quick, we also want to make mention. We got with us Michael with us, Vic with us, Scott. Geez, I was just looking at son's getting married in Hawaii, coming up the June 1st or so. Was just looking at that the little resort there, the Ritz Carlton. Nice place there, and coming your way, Scott. Hello, David, and many others. Just real quick, remember that us coaches, we do post educational content on X. I'll show that in just a moment. Just kind of give you a sense of what we talk about and actually post there. Quick reminder that as we get started, this session is being recorded. So if you went to, let's say, if you're on YouTube and you went to, let's say, just search, okay? Right in the search bar, you just typed in Trader Talk Schwab Coaching Webcast. That's our channel. That's where we actually post our content, a place that we post it. And also you could actually, if you say, I'm not on my computer, you could be on your phone, your iPad, whatever you got, and actually watch us on there as well. Now, quick reminder that Scott made mention of the playlist. Yeah, you can go back, just like your favorite TV shows, and watch on TiVo, so to say, previous classes. We talked about missing out on trends last week, being emotional and no routine. You realize how much being emotional has costed all of us? Do you realize how much it's costed us, all of us, having no routine? Okay. We talked about oil, US dollars, rates, and VIX starting to tick back up. We talked about finding trends, potential entry, setup, and strategies, changing market direction, learning bear strategy basics. So this kind of gives you a sense of things that we've actually talked about. Now, also as we get started here today, remember with what we talked about, we'll talk about stocks and options. We'll talk about past examples and new examples. When we bring up options, understand that options carry a high level of risk, not suitable for all investors. Understand that there's different option strategies. Okay, so want to have an understanding of that as well. The information I talk about here today is done for general informational purposes only. Also, when we talk about examples of technical analysis, there's other approaches that may assert some different views. Some of us are fundamental analysis people where we think that's superior than technical analysis. Some of you are technicians and you think that's more superior than fundamental analysis. Okay, we want to kind of use the combination and look and see if there's ways in which it can complement. There's also intermarket analysis, which is very interesting. So just know that technicals is a starting point. It's not the end. When we talk about our examples, we'll do those in the paper money software application. Investing involves risk. And also when we talk about probability analysis, theoretical nature, not guaranteed. If we bring up, let's say, futures prices, we're not trading futures. Ben Watson teaches the futures. We'll look at some of the futures prices and how that relates to the indexes and sectors and so on. And also when we talk about our examples, we will talk about the technical analysis of the trends. We'll talk about some different time frames, daily and weekly charts, and we're going to look at some of those examples on the chart. First thing I want to take a look at first is, speaking of futures prices, these are some futures that some investors might like to look at when they wake up. The advantages of looking at the futures prices is because if you're a stock trader only, you don't necessarily see the Dow Jones, the DJX. So if you bring this up, DJX, you're not going to get anything until 9:30 a.m. Eastern. But if you actually look at, let's say, the /YM, and we were before the market hours, 9:30 a.m. Eastern, we get a sense of approximately at that point in time where the Dow Jones is. Okay. Now, if we see a plus 0.5% or down 0.5%, it's kind of really just kind of going more sideways at that moment in time. Now, so I do want to point out though, silver, hi-ho silver, getting a 10% push here in 24-ish hours, 36-ish hours, 10%, okay? Now, gold, actually, if you take a look at gold, it's also had a pretty good push. If you take a look at, let's say, crude oil, okay, that has actually gotten a push down. Some investors liked it better when it was at 90. How many of you liked it better when it was 90? And also, if you look at, let's say, now when we talk about, so those are some I wanted to point out. The last one I want to point out in terms of, let's say, a commodity, it's copper, okay? And if you look at that on a daily chart, so we said gold, silver, oil, copper. Of course, if we say those four, you got to say, where's the US dollar? The US dollar has actually been pushed down. We talked about that yesterday. If you look at the copper on a, let's say, 3-year weekly chart, that actually has an interesting Bill Bornhoff intraday bounce. Bill, I know you better than that, okay? Someone from Siberia maybe knocked that intraday low out. I don't know for sure, but I got suspicions. Okay, now, what about the Dow? So first off, this class, we're not trading, let's say, index options per se, but tomorrow morning when Kevin and I talk about ETFs, you know, some investors, I'm looking at the Dow on the weekly chart. Here we are kind of in that V pattern. We haven't really gone down that much on the weekly chart. Some investors, they might say, geez, is there a way to try to get exposure to the Dow Jones? Buying some individual names that might have some relative strength compared to the Dow. Because some people, when they get the red candle, it just means, and that red candle is above the moving averages, they might say, look, I'm going to try to buy on the dip. I'm going to try to buy on the red candle. Some people might try to trade in maybe a different type of product, but stay tuned for actually tomorrow. Is there a product that is trying to track the movement in the Dow Jones? There's not one way to do it, okay? So it could be some of the individual stocks in the Dow itself, something that is trying to track the Dow itself from an ETF perspective, but also could be, let's say, a different type of product, okay? We'll talk more about that tomorrow, but I think that's something to flag on the Dow. Many investors might be looking to see if that can't continue. Is anyone actually thinking that the Dow Jones might break out? Is there anyone here that is thinking, James, I think the Dow could break out? Type in the chat. Now, super quick, when we look at, let's say, the SPX, that actually hit another brand new high here today. I know we want every day to be a green candle, but then if that was the case, you'd say it was too high, right? Okay, okay, don't remind me. So we hit a brand new high. Today we actually kind of fade back. We're not even at the S1 level right now. The equal weighted actually version of this also did hit a brand new high. Kind of looks like that cup and handle type formation over here on the right-hand side. Also, you'd actually have to say like a tilted W as well. So we like to kind of see the equal weighted getting a push when we say we investors. The NASDAQ, if we look at that, again, brand new high. I mean, it's getting so boring, okay? It really feels like it's just getting boring making brand new highs, okay? And the last one, if you want to take a quick peek, what about Mr. Russell? Russell actually doing a bearish engulfing. Some people don't trade small caps, but they use it as a barometer for risk taking. What about the SOX? What about it? The SOX actually paring back a little bit, but that doesn't necessarily mean that all are paring back. We'll point out NVIDIA in just a moment. Okay, hello, Pia. Now, just real quick, when we also kind of talk about, let's kind of talk about just real quick some of these. I want to go to the Dow Jones for just a moment, okay? And let's kind of get to work here. So one that's kind of, speaking of this, okay? Now, by the way, what I'm going to show you here is not a recommendation, okay? So if you scroll down a little bit, remember I kind of said I post on X. And so let me kind of show you a little flavor of what we post, right? So I kind of talk about maybe is there a potential W pattern on Tesla? Just kind of give you an example. And this is on the daily chart. Kind of talk about maybe investors sleeping on Apple. Hits actually 290, right? Talked about, for example, maybe keeping an eye on, let's say, the software space, okay? Scroll down a little bit. You're actually going to see that kind of talked about also kind of the defensive sector market cap weighting getting smaller and smaller in the defensive areas. And also, if we take a look at this, that was on copper, high-ho silver, among others, among some announcements. And also volatility actually being suppressed. So when I'm not teaching, I'm posting. How many times you posted? I've only posted 22,600 times. So occasionally I get one off maybe every day or so. Now, if we take a look at this, I want to kind of pull up an example first. So if we pulled up NVIDIA, now last week we talked about the volume and the open interest. How many of us remember that discussion? We kept showing that last week. Now, by the way, just because you have volume doesn't guarantee that it's going to go up. But let's go back to that for just real quick before we do an example. So what I want to do is I want to go to the trade tab. I want to go to where it says volume open interest. So when we think about stock volume, now you got to think about something real quick. 108 million shares, and it's not even done. Now I made the comparison to NVIDIA compared to maybe, let's say, a product that tries to track the index. I mean, go out there and try to find stocks that trade 108 million shares. I mean, it's not gonna be that many. If we go to, let's say, so first off, amazing, very high volume on NVIDIA. By the way, this is not an unusual day. If we actually go back to, let's say, to the 4 days expiration, just example given, and I'll bring up the 1 day, still seeing very, very, very high, very high volume relative to the open interest. Remember, the option, that's the volume on the option contract of the call and on the put side. Now, remember, the biggest thing is, this is not new. We said this a week ago. There was a dip in the price when actually one of the semiconductor names, they didn't have great earnings and it hit some of the semiconductors. Could that movement that investors were speculating, could it be coming back? Now, we said the problem is we don't know if that's people buying or selling. It's just activity. Remember, if you buy one and then Pia buys one, that's two contracts. If Pia buys one in the paper money account and Sally actually sells one, that doesn't mean there's zero. They're not netted off. Someone buys, someone sells, that's two. Okay? So the higher the volume, the more activity. So we don't know, are people going long or are they going short? Long means they're buying, sell means they're short. The higher amount of volume, there's just more activity. Okay? Now you could probably look at the stock chart and say, could investors be buying and selling? Sure, obviously. But is there maybe a little bit more of a tilt to buying calls than selling calls? Now, let's go down here just real quick. 4 days expiration, still a pretty high multiple. That's a 10 multiple to the open interest. That's a 4 multiple to the open interest. Scroll down. Let's actually go to the monthly, the 15 May, still pretty high. That's a 1-to-1. That's almost a 1-to-1. That's actually about a 5 multiple right there. That's about a 1.5 and so on. We go down to the Junes. Are we seeing anything right there? Biggest one we're actually seeing is on the 215. What about on the put side? Okay, now let's start here. You got to remember something is some people like to buy shares. Some people like to do probability. If we do a cash secured put, that is the obligation to buy the shares from now until expiration. So that is a potential, it is the obligation to potentially buy the shares. Now, you're going to notice that also when we look at the volatility, we are actually going to see that volatility is actually 48. Well, when's the earnings on this? Okay. The earnings is upcoming. So with that upcoming earnings on 5/20 or May 20th, we're probably thinking that volatility might go up somewhat. Now, what that might do is it might numb, okay, some of that time decay. Now, if we can get the move up, it could push down the option prices. So the time and volatility might offset each other, but it still might go back to, does the investor get the direction right? Trade number one. What we're going to show in this case is we're going to try to sell the 210. Now, wait, hold on. If you sell the 210 versus if you sell the 200, which strike is more aggressive? Well, the strike that you sell that is closer to the current stock price, that's the one that's most aggressive. Why would someone do that? They actually think the price is going to go up or they actually don't mind it actually being assigned the shares of the stock. Assigned meaning the investor buys 100 shares at the strike price. If the investor says, I'll sell the 200, still have an obligation, but it's just at a lower price to buy the shares. The strike price, also has a lower break even. I need your help here. Scott, you're not allowed to answer. Would you consider selling the 200 or would you consider selling the 210? So the 210s or the 200s? Which? Now, if we take a look at this just real quick, okay? James L says, why are we still on the option page if we cannot tell the direction from an activity? Well, because we want to actually kind of see, is it just an interest in just an option page over the next day or two? Or are there actually people that are actually maybe layering on activity over different months? If it's just something in the next day or two, it's kind of shorter term activity. But if we're seeing a smattering over different strikes, different expiration cycles, and it's in high multiples, James L., that is why we're still on the option page. That is why. Okay. Now, have we seen that before? It was just maybe like for the one day? Yeah, sure. But if there's that activity where it's over multiple pages, and then we go to the price chart and we actually say, okay, this is what it's showing on the daily chart. Okay. The 1 year daily chart, the triple top area, that 193. So we kind of get like a little bounce off that old resistance being the new support. We could actually go over the fundamentals, feel free. But if we actually take a look at this and go back to a 3 year weekly chart, we could maybe start to speculate what those technicians, fundamentalists, option strategies investors are thinking. Now, here's the deal. Is everyone going long? Probably not. Some people are going short. Some people might be doing a covered call. Some could be doing a collar. But the moral of the story is those are still bullish positions. Okay? Now, if we looked on a weekly chart, if we close here, this would be like your classic bullish engulfing so far. We go back to the trade tab, example given, we're going to sell the 200s. Now, here's the deal. If the investor says I'm going to sell the 200s, okay, so if I bring up NVIDIA, just real quick, NVIDIA, and then we're going to look at some past examples, what I'm now going to do is I'm going to have to, let's go to the IRA, see if I can get this trade off. I'm running out of capital. Forgive me, okay? We're in paper money, okay? Sell vertical. Now, this is not the vertical that you're thinking about, okay? We're selling the 200. That's the obligation to buy the shares. So here's the deal. If you do cash secured puts, you are trying to buy the shares to some degree at the strike price. You might not get the chance, but you're saying, I don't mind in buying the shares. So if someone says, hey, you do cash secured puts, you're not a stock investor, that's not true. Because that is the obligation. You could be the buyer of the shares at the strike price, okay? Now, this right here is the downside, protection. We're doing that for a reason where we're not trying to actually tie up as much capital, okay? So what I'm going to do is I'm just going to buy some downside protection. I don't plan that it ever is going to go to there. It could, but I'm going to say example given, which one do we have here? And we pull this up. If I went to a delta of 10 or less, which is consistent with what we've talked about. Now, we don't have to do that. We could say, you know what, James, I'm going to go lower. If we go lower, what is that going to do? Well, you widen the spread out. You actually set aside a greater amount of capital, okay, to be in the position. So if we do the 200 and the 170, there's $30. But if you got a $5 credit-ish, it's probably going to be about $2,400 set aside to be in this position. So to buy the put to the downside, it actually makes a defined risk, okay? Defined risk. Number two, what that defined risk is built into the trade. But really, if we kind of think about what the trade is, it's really a cash secure put with downside protection. If we didn't buy the put to the downside, we need to set aside almost $20,000 to be in the position. You decide if that's worth it for you, okay, in the paper money count. Break even, 194.16. What we're now going to do is I'm going to try to see if this fills. Could get rejected. Send the order. Oh, it might work. Now, I want to go back to something just real quick. And so trade number one fills. Now, let's go back to the margin count for just a second, okay? Not everything is about putting on new positions. Example given, what I want to do is I want to look at Devon Energy. Now, sometimes we could be slow to actually like identify that there could be sell signals.
Now, the whole purpose of the trend column there and the whole moving averages is to actually help us identify positions that we have and could there be sell signals. So first off, we know that trend number one is probably not a buy signal. Trend number one means that stock is below both moving averages. So that's not great. Okay. Now, the second thing that it kind of tells us about timing here on this stock position of Devon is actually the whole moving average went red 1 day ago. Well, we'd want to know that, right? We're not looking to sell something after it's been down for 42 days in a row. The whole moving average has been down for 2 days. So we got a problem here, okay? So all of a sudden, the trend, it's below both moving averages. The momentum is negative, trend's negative. Second, the whole moving averages are red, and they're red for the last 1 to 2 days. Now, let's not make this complicated, okay? A lot of times, as people, we like to make it really complicated. Now, here's what I'm going to do is I'm going to go back to this. Now, you can look at this and say, yeah, with what we've actually seen with oil, it's bad for the whole entire portfolio. Actually, it hasn't, okay? We did some examples of energy just in case, let's say, the situation abroad got worse. It actually kind of got better, maybe, but it's not completely resolved, and it probably might not be for a long time. Now, the big actually thing is when you look at this, shorter term moving average went red. We call that strike one. Strike two, we go over to the next day. We actually saw a cross, but let's just say we didn't see it until yesterday. So on May 6th, yesterday, we saw really red line on the short-term moving average, strike one, strike two, the cross, strike three, the short-term moving average. Example given yesterday, that could have been the confirmation of a sell signal setup. If someone said, I want more confirmation, that was the confirmation yesterday. Now, if someone didn't see that and said, well, what about today? It's just more confirmation of what we saw yesterday. So we're going to go back into the monitor account. Now listen, the paper money account is trying to be in positions where the price is above both moving averages. Devon does not fit that. So what we're going to say is we're going to right click on that, create closing order. We're going to say, look, we're going to take the $13 loss, sell the shares, try to get the capital back. That way we could try to use it maybe for something else. Sell those shares, could try to move it to the mid price, and then go confirm and send. Now, you got to think about, let's say in this paper money account we had, I don't know, let's say 3 energy positions. That was maybe like a bearish hedge for the portfolio. That if volatility spiked back up, those energy plays might benefit. But if we had 20 other positions that were not energy, well, it would probably tell us that if maybe the volatility in the market didn't spike, the 20 other positions would probably offset the energy positions. And that's really what's happened, okay? If we went back and said, let me see statistical what's happened. Well, when we go back to the 3rd of May, the count was at 46.2, 46.175, 47.3, 46.688. So what's happened is, yes, some of the energy positions went down, but statistically, we actually saw that the other positions that were not energy or hedges, well, they outran the losses in the energy. Okay. Now let's look at, for example, trade number 2, and then I'm going to also be mindful of questions. I want to go back to just real quick. Let's go back to some of these examples, and I'm going to go back into. Let's take a quick peek at GS. Now, sometimes when you look at an example, this is an example of a crossover today, and it's a red candle. We've talked a lot about that. That wouldn't deter many bullish investors. What I'm going to do is I'm going to set a alert right at today's open price, okay? That if we get at or above today's open price, let us know. Now remember, if we set an alert, that's not an entry to get in. It's like an alarm clock, okay? It's like a Ring doorbell. Someone's at the door. In this case, it's not someone at the door. The price is above the spot that you right-clicked on. And I just want to know that. So if we all of a sudden we start getting above today's open price, could that be bullish engulfing back up? Keep an eye on Goldman Sachs. Super quick, actually, on the Apple front. When we actually go back to Apple, we talked about that getting above that extension level. It did make a brand new high today at 292. Again, sometimes you have to punch those new highs. Okay. If there were bearish investors, which has been a painful week for those bearish investors, well, you got to knock them out. And so you got to, if they have stops, stop them out. And then if it actually pulls back a little bit, it actually, for example, maybe some people buy a little bit closer to support. Now, super quick, when we look at that 3-year weekly chart on Apple, you're going to see that here's what we have. Now, let me kind of change the candlestick chart to a Heikin-Ashi. What that's going to really do is it's going to really filter out some of those candles. It smooths them out. Now, if you look at this on an intermediate basis, this class is trading the trend, right? Well, when you look at that, this kind of looks like an intermediate to longer term flag. Let's go to a monthly chart. If we go to the monthly chart, 3 years on a monthly, what does it look like? It'll smooth it out even more. You're going to kind of see that the last couple months, we've really been making kind of this old high turned into the low. The old high turned into the new low. I call that stair stepping. Okay? High, low, high, low. And what you're now noticing is we had a high, and we're now, this week, we did make another brand new high. Now, if we take a look at this, we might kind of be wondering, could that maybe area of, let's say, 276 become a support, 277 or so? Could maybe the midsection of that, maybe 260, really become a level, okay? Now, I think one of the biggest mistakes that investors make, myself included, is every day we make a new watch list. The problem with that is, have you ever looked back and said, man, I had that. I had that. Okay, now the first time I ever looked at Apple, it was $13 a share. And a guy told me that Apple was overvalued. I've been looking for that guy for years. He told me it was overvalued and the company was junk. That's what he told me. I'd tell you his name, but I won't, okay? So here's the deal. First thing you need to learn for yourself is learn how to think for yourself. If you rely upon other people, okay, you're going to tell a story like I just told, okay? Now, which is very sad story. Ooh, almost makes me get emotional. Okay, now here's the deal. What we're going to now do is we're going to go back to this. Let's go back to style, and what I'm now going to do is go to candle. Now, if we take a look at this, if the investor said, you know, James, we see this intraday high, I want to try to get in a little bit closer to the moving average. Well, that's where there's different order types. If you're saying, look, I want to try to buy off maybe a moving average, maybe something, where is the moving average? That moving average, if we take a look at this, where is it? It's at 285. How close do you want to try to buy off the moving average? Well, James, I'll take maybe $1 off that. Okay, so I'll right click on that chart. Well, I'm going to go to buy custom. I'm going to go with OCO bracket. Okay, now, once I do that, what I'm now going to do is let's kind of bring up a little sheet of paper. Now, that little sheet of paper, let's say, for example, that we decided, hey, I'm going to, for example, what's the entry spot? Well, we're going to try to buy at 287.36. The support level, which if you did not listen to the stop discussion yesterday, from trading growth and value, you need to make sure, okay? If we actually said, look, I'm going to set the stop underneath 280, that's going to be really, really tight. Let's say the investor said, James, I'm going to go down to maybe that 276 where we made the higher low and set the stop below there. Now, the stop is at 270.48. The risk per share forecasted, why'd you say forecasted? Because we know stop is not the actual, okay? It's a trigger to sell, but we don't know where it's going to sell at. Now, some of us like to look at, let's say, ATR. Since Scott's with us, we'll give him a moment here. And if we look at the ATR, let's double check. What do we got? And the answer, the survey says is, well, it is going to be 652. Why do we care? Well, if we pull this up, we want to kind of look and see what's the risk per share relative to the ATR. And remember, if you're taking risk about 2 times the ATR, that's probably the tightest stop we probably have. So when we look at that risk, the 1688 over the ATR, remember I just said I want to see a multiple of 2 times to give it some fluctuation. That multiple is 2.58. Okay. Now, if we take a look at that, it's 2.58. And so what we're going to now do is just going to set the stop 270. Okay. What? 270.48. There it is. 270.48. Is this an option trade? No. Okay. Now, I think it should be pretty clear that if we're buying it, first of all, if we only have a portfolio of, let's say, $48,000, which don't say it's not something, let's say that this portfolio started out at $40,000 at the beginning of the year, hypothetically. It's at 48. Now, we could talk about percentage-wise where it is today. That doesn't mean it's going to do it in the future. It could lose all of it. But the biggest actually thing is to go through $40,000, $48,000 of capital in stock, it wouldn't take but a day, probably. And so sometimes we try to use the capital we have, but also options to try to leverage to also have the stocks working, but also other strategies that we could also try to get some movement as well in the portfolio. We're not against stocks. It's just easy to run out of capital, okay, quickly. Dated GTC, dated GTC. Now, there's advantages of using stocks over options. That's the other thing we want to note. Biggest thing is there's no expiration. Now, the second thing on this, when we talk about the target, I'm just going to go back to this target. I'm just going to go back to what that channel width was. That channel width, when we actually go back there, that channel width, let's say it's $30. $30 on top of 279, 310-ish. So I'm going to put the target at 310. Now, if we pull this up right there, okay? Now, if we said, look, on this portfolio, I cannot do more than 10% of the account value, how many shares would it be? And it's going to tell us about 16 shares. We would need to double check that with what would that loss be on a dollar amount, check the percent like we talked about yesterday, and could we buy 16 shares? If we did that, go confirm and send. Always remember how that stop works. The same if we go to that price or less, trigger it to sell. We don't know what that loss is going to be because that is a market order. Now, what I'm now going to go ahead and do is send the order. Now, if we take a look at this, now, by the way, there is a survey in the chat. It's 2 questions. So when you click on that, I'll slide this over for just a moment so you can kind of see. Just kind of click on that in the chat and it asks 2 questions. So you'll see that link in the chat. Click on it. Just kind of hold it there for just a second, okay? But this is very important because when I kind of think about ideas of what we're going to talk about, I'd probably say 65% of it comes from the comments that you write about. So where did you get the idea of what we talked about yesterday? From the comments, okay? And so make sure that you actually click on that, and thank you in advance for filling that out. All right, now, what I also want to do is let's go to see if there's any other questions. Now, James L says, is stop greater than 2 times the ATR as a minimum based on strong uptrending market? Well, what many investors have found out is if you set your stop inside, I mean, and we could go back and statistically look at this. Now, by the way, you could kind of think of this as, James, like you could go back to this chart and it wouldn't take a whole lot to do this. But if let's say instead of this white line being at an 8-day low, we could run that line at a 1 ATR. And then what you could do is say, look, I'm going to use that red line as a 2 ATR. And what's going to happen is you could go back over time and see how many times over the year that trade would have maybe potentially been stomped out. Example given, like probably in there, like in there, like in there, like in there, like in there, and so on. You just have to formulate it. It wouldn't be even that hard to do it, okay? So remember, if you set your stop inside 1 ATR, is a very high statistical chance you're going to get stopped out. It's like saying in your checking account that you need $3,000 a month to live, but you only have $400 in there. What's the chances of getting in the overdraft? It's the same idea, okay? So people like to have a cushion. If you have a bad day, one ATR, it's probably going to get stomped out. Could even get stomped out in the morning, okay? So you try, remember, we're trading the trend. We're not trading the intraday chart, trading the trend on a daily chart. So when I say daily chart, I'm talking about the 1 year daily chart. Okay. Now, other questions. So first off, I do want to kind of make mention of a couple other stocks. Let's go to these real quick. So first off, when I also go back to like stocks like Zscaler, keep an eye on some of these software names. The group as far as software hit a 3-month high here today. Stocks, for example, like Microsoft, some people have been looking for to see if that can't reverse. This is kind of at a spot right there where we had a resistance there. We've kind of actually formulated a base. If we were going to look at, let's say, Microsoft for just a sec, remember we talked about the timing of entries. Well, the timing of entries we classify as really 1, 2, 3. 1 is where the short-term moving average actually goes green. It did. 2 is when we actually have a crossover or the 20-period moving average going green. And lastly, if the moving average crosses over or the 20-period moving average goes green. The reason why we say that is because we don't know which one's going to come first. Example given back here, we had 1, and then we had 2, the crossover, then we had 3. Now, sometimes you can get the 20-period moving average going green if there is a really aggressive move before the crossover. So we don't know which one's going to come first. So we just have to say, look, 1, 2, 3. Which one comes first? If I looked in this example, the crossover happened first. That's why I label it as 2. If we get a big punch here today at the end of the day, could that moving average go green without it crossing over? Yes, and if it did, that's 2. That's waiting for more confirmation. Now, some people, they say, James, I want to see at least a 2 before I get in. Some people say, no, James, give me that 1. I like to get in 1 because I'm closer to support. Now, the good about that is you're close to support. The con about that is you don't have that confirmation. So whenever there's a good, there's a bad. Okay? It's just like a rose, right? See the rose, but there's thorns. Okay? So now here's the deal. Whether we get in 1, 2, 3, we know there's risk on all of them. Now, let's say the investor said, you know what, James, I'm going to actually go back. Let's just double check the numbers. Okay. So if we said, hey, let's say 421.43, support, we got 409.12. If we set a stop less 2%, well, using a sheet of paper, we got $400.94. Forecasted risk per share, $20.49. Okay. Now, if I said ATR, we can see what that ATR is on the bottom there. And as I point to it, that ATR over to the right looks like, well, I'll point to it. You're now going to see in this case, it's 11:27. Do you see? I'm pointing to the day. When I point to the day, it tells me what the ATR is for today or whatever day I point to. It's 11:27. Now, if I look at 11:27, it's going to tell me that risk ATR multiple is 1.81. What does that probably tell us? It probably tells us that dadgum stop. Dadgum. Okay. Pia, can you translate that for everyone? What do I mean by dadgum? Okay. Dadgum means it's just going to be, well, tight. And you said that closer than a 2 multiple. If you said, man, we had a bad day, I got stomped out, I hate stocks, well, you just walk right into what we just talked about, okay? Now, that's going to tell me that maybe I'm going to move down that stop a smidge. I might go down to, let's say, 408 in this example, 407. If I went down to 407, maybe $2 lower, not life threat, not shattering, okay? $2 lower, oh no. it's gonna give me that multiple that we're talking about. Now, if I right click on the chart, now if this goes up, the investor is gonna say, yeah, I always nail these things. I'm telling you, my technical analysis was perfect. That's what the investor is gonna say. Okay, and they're gonna say, yeah, I'll tell you what, I'm just smashing it right here. The fact of the matter, nobody knows if it's gonna go up. They don't know. Okay, think it's gonna go up. That's why they bought it. Okay. Now here's the deal. If we look at this to stop at 390, 398.86. If I type in 398.86, there it is, stop date GTC. Now, Microsoft, it's a stock position. Now, that target right there, which we don't know if it's going to go up to that area, I'm going to go back to this and say how much money, if we said $4,800, okay, $4,800, that's going to be about 11 shares. Now, don't laugh at 11 shares. We already went over that last week, okay? Now, if we went back to this here, what might be the area if it goes up? Okay, well, if it goes up, the next area, if it went up to where it gapped down from about 442, past the 442, maybe in the area, let's say 467. Now, from a fundamental standpoint, if the company knows that there's kind of some negative news about AI and software and things like that, well, just like what Google did and Meta did, they could reduce headcount, which they've already started doing. Okay, they could try to actually make sure that they're actually doing things to get more in line, right? The companies, I mean, they're the CEO, CFO, they're watching their multi-million-dollar portfolio get pushed down. So is the board of directors. Okay, they're going to try to strategically get the company in position to benefit from the tailwinds of the market, the sector, the industry group, right? Okay, now they're trying. It doesn't mean they're going to pull it off. But now what I'm going to do in this case is I'm going to set the target right at about 442.38. Now, some people look at reward to risk to the upside. It's a fabrication. It's a general idea. If we set a lower target, greater chance to hit it. Doesn't mean it's going to. We set a higher target, lesser chance. Okay? It's all about math, psychology, and strategy. Now, if we come back and say confirm and send, we'll hold that there. Now, if you actually said coming up next, just a quick reminder, okay? When we actually go back to this, quick reminder that, remember, you can watch the recordings. We post those recordings right on YouTube, a place that we actually do, not the only one. Make sure that you subscribe. If you haven't done that yet, do that. Second, if you said, James, could I actually go back and see other classes that you actually taught? Right there. Second, that I also want to make kind of sure is if you said, you know what, we have Scott with us. And Scott actually, for example, teaches a class on getting started with stock investing. And you're going to notice that you can go back and click on classes that were also taught as well. Okay. So this page is very important because A, it's going to tell us what we actually taught during the week. Second, what's coming up next. What is coming up next is short verticals. Also, last reminder on this, if you said, you know, if you were said, James, I'd like to actually go back to just Scott Thompson. I think he's a better teacher than you are. Have at it. Okay. Or if you said, you know what, I really enjoy listening to, let's say, Brett Crowther. Well, he teaches there. So we can see what Brett teaches and also other coaches like Ben Watson. It's going to show the past classes and you click on those, it will pull up the recording. Make sure you know how to use that page. Okay. Big win for you. Now, I'm out of my time here today. We went over a couple examples. The majority of our examples was stock trades. Now, the biggest also thing to remember is when we talk about trading the trends, we're trying to let things trend. And so with that, it's not that we don't have risk management. We're just trying to allow the stock to make higher highs and higher lows. And also trying to be in those areas of relative strength. Tomorrow morning, I'll be back on ETFs. If you'd like to kind of learn more about that, check that out. That is live only tomorrow. Stay tuned for Connie Hill coming up next with short verticals. Also a reminder, there's a survey in the chat. I showed you how to click on that. There's only 2 questions. Thank you in advance for filling that out. And also thanks to Scott Thompson as well. Now also remember that all investing we talk about involves risk. And this has been the class on trading the trend. Don't get mad at the trend. Think to yourself, how are you riding that trend? That's the question.
Thanks so much. Take care. Bye-bye.